Hello friends, welcome to this session for CMA intermediate students. So let's ask a very simple question first. How to use these videos? Who should use these videos? And the answer is use these videos for the purpose of revision. If you have already studied this paper 10 section B financial management once, then these videos are going to be a fantastic revision of all major concepts covered by this subject. So are we going to cover 100% of the syllabus and even each and every single point given in the study material? My answer will be we are going to cover all important concepts, all major concepts which are given in your syllabus. Do I need separate notes for the purpose of these videos? No, you don't need it. Somebody may demand even that, okay, whatever we are seeing on the screen, can I get in the form of a PDF file? And the answer is simply no. Some of the questions, some of the formulas you will see on the screen, all major concepts are already covered in the study material. So number one, there is no need of separate notes. And number two, even if you feel a need for the same, it is not going to be provided separately. If at all you wish to have this, you can simply pause the video and note it down in your own notebook. Then, besides doing revision from this video, it is highly recommended that you try to solve all questions given in the study material issued by institute, as well as you are required to solve past examination questions. All right. So with this, here I go now with the first thing about introduction of financial management. So there arises a question that what is financial management? And the answer is like this. Financial management means management of money. Isn't it very simple? Management of finance, management of money is financial management. You know, there are many branches of management: production management, marketing management, human resources management, and financial management. That is management of money. So what do I do as a finance manager? Answer is very simple. You do procurement of funds for your organization, and then you make effective utilization of those funds. That is the simple task as a finance manager. It sounds simple, but really it's very complex. But yes, definition is very simple. If somebody asks you what is financial management, you will say financial management means procurement of funds and its effective utilization. Okay. So what is the objective of financial management? What do I want to achieve by procurement and effective utilization? So look, there are two theories for this concept. One is called the profit maximization theory, and the other one is called the wealth maximization theory. Now, as the name suggests, profit maximization theory says that basic objective of doing business is to make profit. And concepts of financial management are being used in a business. That's why the objective of financial management should also be maximization of profit. It means that as a finance manager, whenever you take a decision, you should take a decision in such a manner which results in comparatively higher profit for your organization. But let me tell you that profit maximization is a very narrow objective. It can be taken as a limited purpose objective, but it cannot be taken as the ultimate objective of financial management. There are many problems associated with the concept that the objective of financial management should be profit maximization. Now, what are the problems if you take profit maximization as an objective of financial management? Number one, they do not define the word profit. So, are you talking about maximizing long-term profit or short-term profit? And let me tell you, they are inversely related to each other. Number two, profit maximization theory does not consider time value of money. That's another disadvantage. Number three, profit maximization theory does not consider risk factor. If you have two mutually exclusive proposals, and obviously you have to choose one and reject the other one. And if you select a proposal, if you select a business with higher expected profit, usually it will have higher risk also. Suppose the profit is double and risk is 5 times, then actually you are taking a wrong decision. Higher profit usually comes with a very high risk. Now, profit maximization theory does not consider that risk. Also, this theory does not consider social responsibilities of a business. So, businessman is there not only to make profit, but also to help grow the society. If profit maximization becomes your sole objective, you cannot survive in long term. This theory does not consider social responsibilities of a business. And also, profit maximization theory is not suitable to the not-for-profit organizations. Let's talk about ICMAI itself. So it's a not-for-profit organization. Still, it collects huge amount of money and then it spends the same for welfare of members and students. So it procures the fund and it utilizes the fund, and that's why it need to use financial management. But you can't say that the objective of ICMAI should be profit maximization. So this theory is not suitable to not-for-profit organizations. If so many problems are there with this theory, then what should be the objective of financial management? And my answer to the question is wealth maximization. Objective of financial management should be to maximize the wealth. What do you mean by wealth? Wealth means market value. What do you mean by wealth? Wealth means market value. And total market value is equal to market price per share multiplied by number of equity shares. So if a company has issued 1 crore number of shares and market price per share is 500 rupees, then 1 crore into 500 rupees will give you 500 crore rupees of market capitalization or the wealth. So a finance manager should take any decision in such a manner which results in highest wealth for the shareholders of the company. Now see, how do I calculate the wealth or the value? So let me tell you that value is equal to performance divided by expectation. If you are calculating value of ABC Limited, then it is dependent on performance of ABC Limited. That is how much profit does it earn and how much dividend does it distribute, divided by expectation of return of equity shareholders. That how much return do they want from the company. If I am talking about your value, then your value is dependent on your performance divided by expectations of others from you. If you enhance your performance, your value in general will increase. If people start expecting higher from you, then even with the same performance, your value will come down. So as a finance manager, you should take all decisions in such a manner which results in higher performance of the company and lower expectations of investors. So ultimately that will result in a higher wealth. Right, guys? So this was an introduction to financial management. Now we are going to start a small chapter titled as Time Value of Money. Let me tell you that this chapter, named as Time Value of Money, is not given in your study material. It is not part of your syllabus. It is actually a fundamental which is required to be studied so that you can smoothly study capital budgeting and some other chapters. Okay. So here I go. Time value of money. It says that a rupee today is more valuable than a rupee a year hence. So if I offer you rupees 5,000 today versus rupees 5,000 after 1 year, definitely you will prefer 5,000 today. Because if you receive the same money after 1 year, it will lose value. A rupee today is more valuable than a rupee a year hence. If I speak one sentence in Hindi, I will say आज के 1 रुपए की कीमत 1 साल बाद मिलने वाले 1 रुपए से ज्यादा है. So why is it so? See, that's very simple. If you receive money today and if you lend it to somebody, you will start receiving interest income. If I give you 5,000 rupees today and you invested somewhere at the rate of 10% per annum, after 1 year you'll get 5,500. On the other hand, if I give you rupees 5,000 at the end of first year, you will simply have 5,000 rupees at the end of first year. So why do we have time value of money? Reason is interest. See, in an economy, if the interest becomes 0% per annum, then there will not be any time value of money. Time value of money exists because there exists the concept of interest. Now, how do people calculate that what should be the rate of interest on their investment? So interest rate actually, suppose interest rate is 12% per annum. Now it comprises 3 elements. The most important element here is compensation for deferment of consumption. If you give me your money, say for 1 year, I am borrowing, you are lending. You give me rupees 1 lakh today, I will return it after 1 year. So you are sacrificing your current consumption, isn't it? This is your money. And suppose you are going to buy a good bike, a good two-wheeler with 1 lakh rupees in hand. But suddenly I appeared and I am saying that, okay, give this money to me. I will give it back to you after 1 year. Then you can buy the bike and ride it and enjoy it. So to give a loan to me, you will have to sacrifice current consumption. You will have to defer the current consumption. And for doing this sacrifice, you will demand a compensation, say 3% per annum. Then after 1 year, when I return the money, the price of the bike might rise, say from 1 lakh rupees to 1,03,000 rupees. So there is inflation in the economy, and that's why you'll ask compensation for that also. So even if you're investing in Government of India bond, you will still expect 3 plus 3 equal to 6% return. But rather than investing your money in Government of India bond, which is considered to be risk-free, if you invest your money, say in my company, or you directly loan it to me, then there exists one risk, that I can make default in repayment of your loan. If you are bearing the risk, you will demand for a risk premium also. So 3 plus 3 plus 6 equal to 12%. So this is the reason that rate of interest exists. And if the rate of interest exists, then there exists the concept of time value of money. Now, what is the formula to calculate future value or present value of a single amount? See, the formula to calculate present value of a single amount is very simple. This formula is PV is equal to FV divided by 1 plus R raised to the power n. See, there you can use any other symbols, but the meaning should remain same. Present value is equal to future value divided by 1 plus R raised to the power n. Or you can write it like this also. Present value is equal to future value multiplied by 1 divided by 1 plus R raised to the power n. Simply look at this formula. If R increases, then present value reduces. If n increases, in that case also, present value reduces. Okay, so let's quickly do one question on the same. And the question says that calculate present value of rupees 11,000 receivable after 4 years if the rate of interest is 14% per annum. Okay, before I move on to the solution, let me tell you that in this video, any point of time you feel like that the speed is comparatively higher than your grasping speed, then you can simply pause it and you can rewind it and play it again, right? Okay. So you have to calculate present value of rupees 11,000, which is receivable after 4 years at the interest rate of 14% per annum. Look here. The formula for present value is future value divided by 1 plus R to the power n. Here future value is 11,000. Rate of interest is 14%, and that's why this is 1.14. Number of years are 4. That's why the power is 4. And when you solve this, you'll get it equal to 6513. How do you do it on your calculator? It's very simple. You type 11,000 divided by 1.14, and then as soon as you press equal to sign first time, do you know what figure do you get? Actually, when you press equal to for the first time, you have brought down this 11,000 rupees from 4th year to 3rd year. Then equal to once again 3rd year to 2nd year. Then equal to once again 2nd year to 1st year. Then equal to once again 1st year to 0 year. And this is how you can make power 4 while calculating present value. And the answer is 6513. Okay, if this is not working on your calculator, then maybe you should try some other calculator model, because the chip design of some of the calculators are like this, that they may not support the shortcut which I discuss in the class. In that case, you have two choices, either to change the calculator or to derive your own shortcut with your own calculator. I will let you know a very simple thing about your calculator. Just like in the banks, they say KYC, know your customers. Here I'll also say KYC, know your calculator. Okay, let's just do one thing. On your calculator, you type something like 10, just do it with me. Come on. Okay, turn on your calculator. Type 10 plus 2 equals to 10 plus 2 equals to. Is it 12? Obviously it should be. Press equal to again and it will become 14. Equal to again, it will be 16. Equal to 18, 20, 22, 24, 26 and so on. So when you do A plus B and keep pressing equal to thereafter, actually this is the B which becomes constant. If you're doing 10 plus 2, then 2 will automatically become constant. You keep pressing equal to and 2 will be added each time. Okay, let's experiment with something else. You type 100 minus 2 equals to. Is it 98? All right. Press equal to again, it will be 96. Again 94. Again 92. Again 90. What does it mean? If you do A minus B, actually B becomes constant. And by simply pressing equal to again, you can deduct it again. Okay. Let's do 400 divided by 2. This is 200. Equal to again 100. Equal to again 50. Again 25. Again 12.5. Again 6.25. When you do A divided by B, actually B becomes constant. Okay, this time let's change it a little bit. You just do one thing. 2 multiplied by 10 equals to obviously 20. Again press equal to and it will become 40. Again equal to will give you 80. Again equal to will give you 160. You have done 2 multiplied by 10. And here, if you do A multiplied by B, then actually A becomes constant. Now this is interesting that for addition, subtraction and division, the second number becomes constant, while in case of multiplication, first number becomes constant. Use this simple fact to create your own calculator shortcuts. So what did we do over here? 11,000 divided by 1.14. This is A divided by B. So actually B becomes constant. And every time you press equal to, your calculator actually divides the result by 1.14. So first time equal to, fourth year figure comes down to third year, then third to second year, second to first year, first to 0 year. That's it. Okay. So this was present value of a single amount. Now let's calculate present value of a series of amounts. What is the present value of following cash stream if the discounting rate is 14%? Interesting. So now we don't have a single amount. You have a series of single amounts. In total, 5 amounts are given and you have to calculate present value of each of these amounts individually and then make a sum total. Let's do it. Okay. So look here. Let's start with first year's amount. Because this amount at year 0, this is itself a present value, and that's why I'll start with the 6,000 rupees amount. So simply type 6,000 on your calculator, divided by 1.14, press equal to, you'll get 5263, press M plus. Why M plus? So that we not only calculate present value of these amounts, but also all these present values are stored in memory. Later, we won't have to make a sum total separately. Now, the interesting thing is, for second year, you need not to type divided by 1.14. I told you now, if you do A divided by B, B actually becomes constant. Even if you change A, B will remain same. So now you type 8,000 rupees and press equal to 2 times. 8,000 2 times equal to, this time you have not pressed divided by 1.14. You will get 6156 and then press M plus. This will be stored in memory as well. Then type 9,000, 3 times equal to, 1.14 has become constant. You'll get 6074, press M plus. Then 8,000 for the fourth year, 4 times equal to, you'll get 4737. In fact, when you press equal to for the first time, 8,000 becomes 7017. That is the 1 year down present value. From fourth year to third year, if you bring down, see, future value calculation is like adding interest, and present value calculation is like deducting interest. So if we deduct interest for 1 year, 8,000 will become 7017. Press equal to again, it will become 6155. Press equal to again, it will become 5399. And press equal to again and you'll get 4737. So you brought it down from fourth year to third year to second year to first year to 0 year. Now this 5,000 rupees at 0 year need to be considered. So you simply type 5,000 and press M plus. What is the advantage of pressing M plus after each calculation? These 5 amounts are stored in the memory, and now you simply press MRC switch on your calculator, which is for memory recall, and you'll get 27230. This is sum of present value of series of cash flows at the rate of 14% per annum, right? So after studying how to calculate present value of a single amount, now let's talk about annuity. What is an annuity? So annuity is a series of cash flows which fulfills both conditions mentioned below. See, this is also a series of cash flows. Here, this 11,000 rupees was just a single amount which was receivable after 4 years. But here in this question, 5,000, 6,000, 8,000, 9,000, 8,000. This is a series of cash flows, but this is not an annuity. A series of cash flows where all installments are equal and all time gaps are equal is called an annuity. Here time gaps and installments are not equal, and that's why this was not an annuity. A better example for annuity would look like this. Look here, this example says that If somebody gives you rupees 1000 at the end of first year, second year, third year and fourth year, all amounts are equal. All time gaps are also equal. See, the first amount you are receiving is at the end of first year. So from today, there is a time gap of 1 year. Then after first year, it is second year. So again, there is a time gap of 1 year and so on. Equal time gap, even the first time gap is 1 year. In equal amount. This series is called an annuity. If you want to calculate present value of annuity, one of the ways is to calculate present value of each of the installments separately, make a sum total of all present values to arrive at present value of annuity. Or the other way could be to use a formula. So if I'm talking about a normal annuity, the formula for present value is, normal annuity means where the first installment is received at the end of first year, first period. So present value of annuity formula is A multiplied by 1 minus 1 upon 1 plus R raised to the power n divided by R. Let's solve one question for the same. What is annuity due? What is deferred annuity? That we will discuss later. Okay, yeah, one thing is for sure. In this formula, A means amount of one installment, R means the rate of interest, discounting rate, and N means number of installment. Keep in mind, N is not number of years. No, not at all. N is number of installments. So let's do one question. Calculate present value of annuity of rupees 1000 for 4 years. So somebody is giving you 1000, 1000, 1000, 1000 at the end of first year, second year, third year, fourth year, and 12% is the rate of discounting. And you know the formula looks like this. PVA, present value of annuity, is equal to A into 1 minus 1 upon 1 plus R raised to the power n divided by R. You know, here A is actually equal to 1000 rupees multiplied by 1 minus 1 upon 1.12 raised to the power 4 whole divided by 0.12. If you solve it, you'll get it equal to 3037. Now, what are the calculator keystrokes for doing the same? And the answer is here. You know, first you solve this part of the equation. 1 divided by 1.12, 4 times equal to 1 divided by 1.12, 1, 2, 3, 4, 4 times equal to. You'll get 0.635. Now it should be deducted from 1, or simply you can deduct 1 from this figure. So deduct 1 and then divide by 0.12. When I deduct 1, it becomes minus 0.3644. Then I divide it by 0.12, it becomes minus 3.037. It becomes minus. See, ignore the minus sign, because instead of 1 minus this, you have done this minus 1. 3.037 you might be getting. This is called annuity factor. You know, you must have received this 3.037. This is called present value annuity factor. It means that if somebody gives you rupee 1 at the end of each year from year 1 to year 4, though he is paying 4 rupees, but from your point of view, worth of this series is not 4 rupees, It is 3 rupees 4 paisa, 3.04 rupees. Now multiply this present value annuity factor with the amount of one installment, which is 1000 rupees, and this is 3037 present value of annuity. 1000 rupees for 4 years is equal to 3037 rupees today. If you don't want to use this formula, there is a superb shortcut for this formula. But to run that shortcut, you need to have GT function in your calculator. GT stands for a grand total. So if you have the GT function, you'll be able to use this shortcut. Otherwise not. Shortcut looks like this. 1 divided by 1.12, 0.893. If you press equal to, you'll get 0.893. Again equal to, you'll get 0.797. Again equal to, you'll get 0.711. Again equal to, you'll get 0.635. Now you press the GT switch on your calculator. As soon as you press GT switch on your calculator, you'll get 3.037, which is the present value annuity factor, present value of series of 1 rupee. Now multiply it by 1000, press equal to, you'll get it equal to 3037. Right? What is the logic behind this shortcut? The logic is very simple. Just do a simple math on your calculator. 2 plus 2 equal to, definitely you must have got 4. Then do say 3 plus 3 equal to, you must have got 6. Now press GT, and as soon as you press GT, you will get it equal to 10. Moral of the story, whenever you press equal to sign on your calculator, result is stored in GT memory of your calculator. Yes, there is one internal memory, GT memory, grand total memory. As soon as you press equal to, the result is stored in the GT memory, and actually pressing GT button on your calculator is kind of memory recall. And that's why this shortcut works over here. When you press equal to, you get first year's factor, then second year's factor, then third year's factor, then fourth year's factor, and annuity factor is nothing but sum total of all these factors. Right? Okay. After annuity, now let's discuss about deferred annuity. What is deferred annuity? It is an annuity. Number one, it is an annuity. So, all the amounts are equal. All the time gaps are equal except the first time gap. It is an annuity which begins late. So, suppose it is starting from 10th year, not from first year. But thereafter it occurs regularly, 10th year, 11th year, 12th year, 13th year, 14th year, 15th year, and so on. If you allow me to speak a little bit of Hindi, इसका मतलब ये है कि जो पहला वाला टाइम गैप है वो बड़ा टाइम गैप है, उसके बाद बाकी सब बराबर 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 टाइम गैप है, उसके बाद वाले सारे टाइम गैप आपस में बराबर हैं, पहला टाइम गैप बस बड़ा है. This is the deferred annuity. Look here. Equal amount, 1,000, equal time gap, 5th year to 6th year, 1 year's time gap, 6th year to 7th year, 1 year's time gap. But the first installment is at the end of 5th year, not at the end of 1st year. So first time gap is not 1 year, first time gap is 5 years. In the first installment, there is an extra time gap of 4 years. It should have started at 1st year, while it is starting at 5th year. So the extra time gap or the delay period is 4 years. Now there is a formula to calculate present value of deferred annuity. And the formula looks like this: amount of one installment into 1 minus 1 upon 1 plus r raised to the power n divided by r. Mind it, here n is number of installments, while m is the deferment period, that is how much delay is there in the start of annuity. In this example, A, that is amount of one installment, is 1,000 rupees. This example I am talking about. Now let's assume that rate of interest is 10% per annum. It's not given, but let's assume it's 10% per annum. Number of installments are 3. Look here, 1,000, 1,000. Number of installments are 3. Number of missing installment. What is M? M for missing. N for number of installment. M for missing number of installment. See, in case of a normal annuity, it should have started from first year, second year, third year, fourth year, and then fifth year. So how many installments have been missed? 4 installments have been missed. And that's why M is number of missing installments. If you put figures over here, you'll get it equal to 1,000 into 1 minus 1 upon 1.10 raised to the power 3 divided by 0.10 into 1 divided by 1.10 raised to the power 4. Right, here A is 1,000 rupees. Number of missing installments are 4. Number of installments are 3. To solve this, first of all, I'll solve this part, power 3. Then I will deduct 1. Then I will divide it by 0.10. And once I solve this part, I'll keep it in memory of my calculator. Thereafter, I'll solve this and then I'll multiply it by memory recall. And then I'll multiply it by 1,000. So these are going to be my steps for solving. 1 divided by 1.10, 3 times equal to GTM plus. See, if you observe it carefully, this part of the deferred annuity formula looks like annuity formula itself. So that's why I can solve it like annuity. 1 divided by 1.10, 3 times equal to, and press GT. So this part is solved. And store it in memory, M plus. Now you do 1 divided by 1.10, 4 times equal to. So this part of the question is solved. Now just do one thing, multiply it by memory recall. It means you are multiplying it by this part and then multiply it by 1,000 also. Multiply it by memory recall and then multiply it by 1,000 also. And as soon as you do it, you'll get answer equal to 1698. Right? Though I can tell you a shortcut for the same also. See, here I told you keystrokes to be used on your calculator for the purpose of doing this calculation. What if I ignore this formula at all and try to solve this question that I'll be receiving 1000 rupees at the end of 5th year, 6th year, 7th year, and suppose the discounting rate or interest rate is 10% per annum. See, in that case, what do I do? I'll tell you. So alternatively, I'll simply type 1000 rupees. This 1000 rupees for 5th year. Look here. This one, 1000 rupees for the 5th year. Divided by 1.10 and 5 times equal to. And then press M plus. So here you must have got 621 rupees roughly. This is present value of first installment which occurs at 5th year, 621. Now luckily the 6th year's amount is also 1000 rupees. So there are two ways now. You type 1000 and press equal to 6 times. And press M plus. You might have got 565. Then you type 1000 and press equal to 7 times because this is 1000 for 7th year. And you might have got 513. Press M plus. And finally, MRC will give you 1698. Same answer. So what did you do? Actually, you treated these amounts as single cash flow. This is 5th year single cash flow. This is 6th year single cash flow. This is 7th year single cash flow. Make a sum total. So you ignored the formula totally. Now I can tell you even a shorter way of doing this. And the even shorter way is alternatively, the first step is same. But in the second step, don't do anything. Don't type 1000 rupees and 6 times equal to, because 1000 rupees and 5 times equal to you have already done. And that resulted in 621 rupees. So if you simply press equal to, just do it with me. 1000 divided by 5 times equal to 1000 divided by 1.10, 5 times equal to M plus. You have already done 5 times equal to. So pressing simply 1 more equal to will make it the discounted figure for 6th year. And this must be 565. Press M plus. Then you do equal to 1 more time. And the 6th year figure will become 7th year's figure. And press M plus and memory recall and you'll get the same answer. If you didn't get it, just follow on-screen instructions and you'll get the answer. See, there are 10 more ways of solving the question. But I'm telling you, why I'm telling you 3 alternatives. I just want to give you a message that you can derive your own shortcuts and you can use it in exam also. Okay. Now, one last thing for this chapter, annuity due. See, what is annuity which begins at 1st year? What is deferred annuity which begins late, maybe at 4th year, 5th year or 10th year? What is annuity due? So this is something, an annuity in which installments occur at the beginning of the each period. So rather than starting from the 1st year, this series starts from 0 year itself. rather than starting from first year, this series starts from 0 year itself, and that's why it is named as annuity due. So it's not starting from first year. See, it is starting from 0 year. At 0 year, you have 1000 rupees. Then at first year, you have 1000 rupees again. Then at second year, you have 1000 rupees again. Then at third year, you have 1000 rupees again. So if you look at it exactly, this is not 1000 rupees for 0 year. This is 1000 rupees for first year, which is received at the beginning of the first year. Now, beginning of the first year is same as 0 year. This is beginning of second year, which is same as first year. This is beginning of third year, which is same as second year. This is beginning of fourth year, which is same as third year. So in a simple language, you can say that annuity starts from first year, while annuity due starts from 0 year. How do I calculate present value of annuity due? And look, there is a formula to calculate present value of annuity due. You know, in the deferred annuity, the formula, the highlighted part of the formula was same as normal annuity. But if you multiply it by 1 upon 1 plus r raised to the power m, it becomes a deferred annuity formula. Similarly, in this formula also, present value of annuity due, the calculation up to this highlighted part is same as normal annuity. But if you multiply it by 1 plus r, it will become a formula for annuity due. So like in this question, 1000 rupees is amount of one installment. Again, try to recall, n is not number of years, n is number of installments. So there are 4 installments, and that's why n is 4, 10% is the rate, multiplied by 1 plus r. Simply 1 plus r, no power here. You solve it and you'll get it equal to 3487. See how to solve it. This part you can solve with GT function, then multiply 1.10, then multiply 1000. You can use keystrokes like that. So 1 divided by 1.10, 4 times equal to GT. This part will be solved. 1 divided by 1.10, 4 times equal to, and then GT. You'll get 3.169. Once you get 3.169 multiplied by 1.10, you'll get 3.486. Then multiply it by 1000, you'll get it equal to 3486, 3487 exactly. Right? This is how you solve the annuity due concept. So that's it for this session. Now in the next session, we will discuss one of the most important chapter from the point of view of examination, and that is capital budgeting. Till then, bye-bye. Thank you.